Well, I think this is a huge risk, and it's a much larger risk for the global economy than the US, because the US is no longer a major commodities buyer, but China is. And if Chinese growth really slows down, or if they have a crash, as some analysts say they will have, then obviously it will impact the economies of countries like Australia, the Middle East, Brazil, Canada, and so forth. And of course also the property markets of Vancouver, Hong Kong, Singapore, Sydney. And then it will backfire in the sense that when these economies that produce commodities have falling commodity prices, they'll buy less goods from China. So it could trigger a vicious circle on the downside, and I would say there is a fairly good chance that this could happen. This would be really something the world central bankers wouldn't be able to help with printing money. They may be able to print money, but it wouldn't really help the real economy. It may help the financial economy to support equity prices.
Mark, hi. My question to do with China is, how long do you think the West will allow for China to maintain its current policies, where it has the yuan pegged at an extremely competitive rate, and they're kind of taking away jobs from the West to China by the day, and creating this huge imbalance where they're accumulating reserves, which then gives them firepower to buy the said commodities? I mean, how long until this eventually busts into a trade war or something of the kind?
I don't think it will be a trade war. I believe, and that's why I'm ultra bearish about everything. But being ultra bearish about everything, I think you're better off in equities than in bonds and in cash. Probably the best will be in precious metals. But basically, I see that 10 years ago, a huge shift in the balance of economic power began from the Western world, notably the US and Western Europe, to Asia and emerging economies. We have today in the goods markets, I'm not talking about services, because services are very difficult to measure. But in the goods markets, the emerging economies are much, much larger than Western Europe and the US even combined. So this shift in the balance of economic power to emerging economies is accompanied by a shift in the political and military power. And that the West will not just sit there and do nothing. I mean, the Libyan expedition is the first shot. I think the Western world will want to control China by controlling the oil supplies from the Middle East. And then it will come to war. And in war times, the one thing you don't want to own is in the US government bonds. Equities will do okay, and precious metals and some commodities probably will do very well. But I would prepare for the worst. But when you think it through, in the worst scenario, you don't want to be in cash US dollars and in US government bonds.
So, Mark, you think it will continue the fact that Chinese companies will be able to sell into the West products that are made where they don't pay any healthcare costs for their employees, where they don't pay pensions? I mean, the playing field is not level.
Well, I mean, but I would add to this, whether a country pays healthcare costs or not doesn't really matter, because the Chinese citizens themselves put money aside. That's why the savings rate is high for their retirement, for their healthcare, for their social security. The problem in the Western world is that people sit there and say, Papa, government will take care of me and everything. They have abandoned personal responsibility for their actions. Everything is insured. I live in Thailand. I don't have any insurances. If something goes wrong, I have to pay myself. But that's why I put reserves on the side and I pay low taxes. And so it's a different system. You cannot just condemn China because they don't have health care that is run by the government. Luckily, they don't have that. That's what should happen in America. They should cut government expenditures precisely 50% and fire half the government, including the president, in the mid-1980s. And I looked at the monetary base in the mid-1980s. Then I compare it to an average gold price of the 80s and 90s. I can tell you, as of today, the gold price is probably cheaper than it was 10 years ago, although in nominal terms it's up 4 or 5 times. But compared to the monetary base and compared to the government debt and compared to the increase in wealth in the world, and especially compared to the increase in international reserves, the foreign exchange reserves have gone from the mid-1990s from $1 trillion to $10 trillion, but the gold price hasn't gone up 10 times. So I think the gold price is low.